Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on this afternoon's market action. We're not too far from the flat line. You're looking at the Dow in negative territory, off just about 27 points. S&P not far from the 9-month high, trading up just about 0.1%. The Nasdaq, the outperformer of the day here. Taking a look at some of the sector action that we're seeing, financials are the winner of the day, at least for now. Regional banks adding to some of those gains. Also, the VIX hitting its lowest level that we've seen since July of 2021, Akiko.
Yeah, let's get to our top story of the day, though. The Securities and Exchange Commission ramping up its crackdown on crypto. Just one day after filing a lawsuit against Binance, the SEC is now targeting Coinbase. We've got team coverage on this. Alexis Keenan is with the details on the charges, and Jared Blickery is keeping track of the market reaction. Alexis, we want to start with you. Lay out the SEC's case against Coinbase for us.
Sure, Akiko. So let's just first say these two suits, they target these major crypto platforms that have been in this long dispute with the SEC over its regulatory authority over both the exchanges as well as cryptocurrencies in general. Now, the SEC says that both companies are violating U.S. securities laws by failing to register with the agency. As for Coinbase, the agency says that the company is also illegally merging market functions that are normally kept distinct from each other. They say it's acting as a broker, an exchange, a clearing agency, and also a seller of securities. They say as a result, Coinbase is then evading disclosure laws that were specifically set up to protect consumers by Congress. Now, as for the case against Binance, it's similar, but it's a 14-count complaint compared to the SEC's 5-count complaint against Coinbase. In the Binance case, the SEC names both the company and the CEO, Changpeng Zhao. It's a 14 complaint saying that the company illegally commingled customer assets also and misled customers as to the company's ability to detect market manipulation. They also said that the company was allowing U.S. customers to trade on exchanges that were off limits to U.S. traders. As for Coinbase, it's already been talking a lot about this case. Its CEO, Brian Armstrong, said the suit might help get some clarity around crypto rules. In an email separately to Yahoo Finance, its general counsel accused the SEC of relying on an enforcement-only technique, saying the solution is legislation that allows for fair rules of the road to be developed transparently and applied equally, and not litigation. They don't like this route, but Brian Armstrong there seeming to say that perhaps if it's got to be litigation, that maybe there's some rules that will come out of it or some distinctions that these companies can follow. But look, guys, this is the 14th case that the SEC has brought against crypto entities since January. So they are definitely on the offensive here.
They certainly are on the offensive right now. All right, Alexis, thanks so much. Let's take a look at how we are seeing the response play out in the market, because Coinbase under a bit of pressure here, Jared. But when you take a look at Bitcoin, it's actually holding up pretty well.
Well, yes, up and away here. Let me just show you what's happening today. This is over the rolling 24-hour period, up 4.5%. Looks like 25,000, which is actually a little bit below here, was a floor. That's a big historical area for Bitcoin. But we can see it is not yet reclaimed yesterday's high. And so this is factoring also the news we got yesterday from Binance. Now, overall, these are two of the biggest players in crypto. So you might be asking, why did not Bitcoin suffer a little bit more? Because that would be the natural inclination. But I just want to show you a 3-year timeline of Bitcoin and the various prices. I've got some SEC news in here, some Coinbase news. I'm just going to go over a couple, but first, Ripple was in the SEC spotlight in December of 2020, so this goes back a long time. Here's where Coinbase listed on the Nasdaq in early 2022, and then here is actually where they got their first little hiccup. Coinbase drops plan to launch crypto lending program. Well, they were in discussions with the SEC for a long time. They wanted to offer interest to their customers on their accounts, the way, well, you could do that around the world, but not necessarily in the US. They dropped that program, but what was later revealed was that Coinbase actually got a subpoena or multiple subpoenas for their efforts. You go to the SEC, palms up, and you're asking for help. Guess what? You get a subpoena in return. This is not new enforcement procedures or new procedures for the SEC. This came out about a year later, and of course, by that time, we'd already seen the downfall of crypto. FTX was in the crosshairs. Lots of things were happening, but want to point to something else. Coinbase got a Wells notice, and that was in March of 2022. Actually, and so that was actually the first signal. That should be 2023, by the way. That was the first signal that there was going to be some kind of probe by the SEC on the other side. So this is just kind of confirmation what a lot of investors were already thinking. But my bottom line here is if the SEC doesn't completely shut down Binance and Coinbase, probably not going to derail crypto. But if in fact the Coinbase business model cannot survive with SEC regulation, that would probably take a long time to play out. Well, that's a different story altogether.
Yeah, as Alexa said, no question that the SEC is on the offensive right now. Jared Blickery, thanks so much for that. Well, Coinbase and Binance may be the latest targets of Securities and Exchange Commission Commission Chair Gary Gensler, but the regulatory backdrop for the crypto industry remains murky. So the lawsuits this week raise questions whether we could see regulation start to take shape sooner rather than later. Let's bring in Kavita Gupta, Delta Blockchain Fund General Partner. Kavita, it's good to talk to you today. As we noted earlier, 14th case that the SEC has brought against crypto entities since January. You've highlighted the fact that this development today is not necessarily a surprise, but it is surprising that they've suddenly identified a group of tokens as securities. I mean, what does that tell you about what the approach is going to be moving forward?
Honestly, it actually raises question on the approach, right? Because suddenly you have some 13 token in one complaint and 12 tokens in one complaint without any explanation why only these 12 or 13 are security. But are they based on decentralization? Are they based on the usage case of it or lack of decentralization? I think the first question when I was reading the complaint yesterday and today is like, why these? And of course, everybody talked about Ethereum was one which everybody was expecting on this. It wasn't there. But I think the questions out there is, what are the bases of picking up these tokens? What are the bases which is going to justify going forward? What are actually securities and not securities? And do SEC actually creates a pathway and say, this is how it should work? Or they just say going back, hey, we didn't give you any clarity, but let's just sue you. So it's been very interesting conversations around that.
Kavita, do you think that this is actually going to drive Congress to eventually take action? TD Cowen was out with a note today saying that this action from the SEC is going to drive a review of the SEC stance, and we could essentially then maybe see something finally happen down in D.C. Do you agree with that?
I think everybody is eyeing the election year. And I do feel like it has become a very politicized topic between Democrats and Republicans because the approaches are very different. Sometime back, Hester Pierce had a document saying that we should have a pathway of what does take a particular token towards saying it's a utility based on how much decentralization over 1 year or 2 year has to happen. And we need to give them a pathway to grow. And that suddenly reappears after a long time in a Republican proposed legislation, which is way more pro-crypto than Democrats. Going back to Shauna, exactly what you asked, I feel like it's just getting a lot of headlines, but where does it really go from there? Because from last 2 years, we just keep on hearing headlines after headlines from SEC, and after the headlines, nothing really moves in any direction. Even the lawsuit which Coinbase did on SEC, apart from the headline, there has not been any progress. FTX fall down, not any progress. So even if you're talking about DC and the government moving in this direction to make a very decisive movement, how much time do we have for them to really do it?
Kavita, the lawsuits that we got this week against Coinbase, but as well as Binance, does that complicate the path for Congress in trying to create this regulation? Because the debate for a long time has been who actually has the authority to regulate. The SEC, in pushing forward with these lawsuits, are saying, here's the guardrails that we're setting forward.
Yeah, absolutely on point, Akiko. Like, there has been a lot of questions about who has the authority. Is it just SEC comes and say, this is security, so now we're going to govern it? It's just like a big field. And CFTC can come and say, oh, we are not sure about it, maybe because of strong leadership or not. And then SEC can come having a strong leadership or very vocal leadership to be at that and say, okay, this is just our jurisdiction. And where does the utility go? I think there has been a lot of confusion between whether it's commodity versus security. If it's security, how should it go? I think what we're going to see are just a lot of questions again back in the market. But what I've learned in last 2 years, never answer either from the government or from SEC. Hopefully that changes this time.
Kavita, what do you think this is going to do to startups just in terms of crypto innovation here in the U.S.? Are we going to see more of those smaller companies look elsewhere to build their business?
Unfortunately, last year and a half already, most of the amazing startups have been incorporating outside US, even if they're US citizens. And we have been seeing the innovation, and I'm not even talking about tokens or crypto, but really good blockchain innovation being pushed out to places like Lisbon and Dubai and Singapore. And this is just going to make it even much more stronger. So that's an unfortunate fact about this all hype and no substance or no clarity on, hey, this is the law, abide by it, and we are all good. Like, there is nothing like that.
I mean, what does that ultimately mean for those investors, those who are holding some of these coins? Because if there's anything we've learned from what happened, for example, with FTX, it was that the fact that so many of these exchanges were operating internationally where the regulatory guidelines were not there, that's what put those users at risk.
So I think there are 2 points which I would love to cover on this. It's a very good question. The first part is that Coinbase did go to IPO in US and disclosed everything. Most of the tokens which has been listed at security by SEC today were already listed on Coinbase when they went to IPO. So what really happened? Did an SEC really signed off at that point of time? So how suddenly you are your job is to protect retail customers. And so you have allowed this to have an offering within US, in fact, have an IPO. And now you're going back and suing and saying, no, you couldn't offer it. So I'm very confused. I'm not a lawyer, but I'm very confused on this. On the investor side, if I say, there was a big crash when FTX happened or Luna happened or 3AC happened. If you see with these lawsuits in last 2 days, the maximum down part which happened in all coins yesterday were 10%. In fact, Bitcoin and ETH went up 2% something today. So the strength hasn't gone in the market. Nobody who are deep crypto natives or investors are actually taking it seriously, because most of the traditional investors knows these are just news headlines. What really is going to happen here? That pathway is going to take 4 to 5 years. Are you just going to make crypto disappear for 4 to 5 years till everybody's figuring it out? That's almost impossible to have, right?
Kavita, is that why we're not seeing more of a reaction in Bitcoin today? I mean, take a look at the price of Bitcoin, up just about 4%, yet you're seeing more of a crackdown here on these exchanges.
So the Coinbase token, the security did go down in a significant way, because of course that's like a one bad news. But I also feel if they're going to report a really good earning report like in the past, they actually still going to do really good. Because at the end of the day, what we have seen in last 2 years, no action and just talk and headlines. So until and unless there is actually going to be a real action and a pathway to figure out something, whether it's an extreme ban or whether it is let's figure it out, it's a long process. People who already hold the bag, are they not going to hold it and suddenly going to crash it? There is no reason to do that, because the Bitcoin, ETH, and the other altcoin, the businesses built on Polygon, businesses built on Ethereum are still flourishing. There's daily new announcement being products coming out on Bitcoin based, like a recent Sam Altman product, which came out raising $90 million. So I feel like the technology utility is so high, the developer adoption is so high, that right now we are just talking about regulations, which are going to take a decade and just going to work around it.
Yeah, it feels like that conversation has continued. Kavita Gupta, Delta Blockchain Fund General and Partner, it's good to have you on today. Really appreciate the time.
Thank you.
Well, we are just getting started here on Yahoo Finance Live. Coming up, travel demand is showing no signs of softening. We'll get analyst insight on why Booking.com is a key winner in the sector. Plus, we'll get expert analysis on Apple's new product launch, the Vision Pro augmented reality headset. And later in the show, we're going to speak to Elf Beauty Chairman, CEO Tarang Amin, on the state of the beauty industry. Stay right here.
Like much of Wall Street jargon, market melt-up is something fancy that describes something pretty simple. This little bit here is what some market participants are referring to as a melt-up, the most recent leg of the rally.
What does a melt-up mean? You see, the market is discounting all these bearish headlines that we're talking about recently, and it still manages to exhibit some bullish price action. So not anything huge, but just kind of melting up.
Just a Wall Street slang, essentially, for a market that won't go down. And it basically kind of pulls in skeptical investors. So imagine something sort of melting and it spreads as it keeps going. And that's what we're seeing.
Well, the S&P 500 has been doing much better than expected so far this year, mostly led by a few big names. The rally causing analysts to raise their end-of-year targets for the index. BMO Capital's Brian Belsky raising his target to 4,550, and Truist's Keith Lerner going up to 4,500. Joining us now with her outlook on the market is Ann Berry, Threadneedle founder. And I'm looking at where S&P 500 levels are right now, hovering near that 9-month high. Does it all make sense to you?
It makes no sense to me. And actually, I was a complete naysayer on the S&P. We'd had this conversation often. I would have thought flat from the summer to the end of 2022, and I would have thought flat to down from the end of last year to where we are today. So this outperformance has been something I certainly didn't expect.
What do you think this means just in terms of where things stand today, the odds of a recession? Because yes, we do have a number on the street raising their year-end price targets for the S&P, but Deutsche Bank is sticking with its call, saying that it still sees a recession here. So where do we go, do you think?
Well, Goldman also came out and said the probability of recession coming down from 35 to 25%. And this is one where the recession keeps eluding us. And it feels as though all the criticism that's been leveled at Jay Powell that he got how to bring inflation down wrong, I think he actually may prove out at the end of the day to show that he can get it down without getting us into recession territory. Also didn't see that coming.
So does that put us in a better position going into year end? I mean, all this talk about a soft landing, a hard landing, it certainly feels like things are starting to ease a bit.
It certainly feels as though things are easing in terms of cost input inflation. It feels as though we've got more realistic outlooks for earnings based on consumer demand. We saw a bunch of big companies flush their bad news for their earnings outlook for the rest of the year, and the market seems to have recovered. So it feels as though, with a couple of exceptions, AI being a little bubble territory-ish at the moment being one of them, expectation seems to be a lot more sensible across the rest of the ecosystem, which in turn, I think, is leading to a little bit of leveling out.
And do you think we'll see broader participation in terms of the winners here? Because a lot of the leadership gains, or a lot of the gains that we have seen since the start of the year have been names tied to AI, most of them at least. Do you think we'll start to see that maybe broaden out?
Well, we're seeing it today. If we look at the market today, and to go back to your question, Akiko, do you understand what's going on in the market right now? Consumer discretionary is on a tear today. Everything from travel to apparel to traditional retail seems to be getting back up in the green today. And it feels as though perhaps there's anticipation that there will be a pause when it comes to the rate decision that's due out next week, which in turn may help ease the burden on consumers. Perhaps that's driving some of it. But I am concerned about the concentration of uplift we've seen in a couple of tech names.
Yeah, I mean, let me pick up on that point because, you talked about a potential bubble, is it not? I mean, it feels like investors are like kind of hungry to latch on to anything that points to the optimism. And AI is just kind of the buzz at the moment.
Yeah. Well, look, I think in terms of AI, here's why I think it's different from some of the other bubble terminology that we've seen over the last couple of years. NFTs being one of them, the metaverse being another. AI has been around for longer and it's real. And there are real applications, not only in the consumer-facing pieces that have captured our imagination. There are real B2B applications, which I think is what's different about AI. I think what investors are trying to do is find the picks and shovels around AI, and that's why we're seeing NVIDIA do what it's doing. But when I think about where the winners will be, I think it's going to be the companies sitting on the massive data sets that drive the quality of AI innovation and application. So I think these big tech winners like Google, Microsoft, they've got the data. And I think the big are going to get bigger and scale is going to win here.
And let's talk about what we're seeing play out internationally overseas, because the World Bank projecting that global growth is going to slow to its slowest level that we've seen, lowest level since 2008. Now the organization does expect growth to slow to 2.1% in 2023, yet we're still seeing a lot of investor excitement
Yeah.
overseas, a lot of outperformance here from a number of the international markets. Where are you seeing the most opportunity at this point?
Well, I'm still a bull on the domestic economy. I think the US is uniquely positioned relative to Europe, relative to Asia, to continue to have what I would call sort of intelligent growth. It feels as though it's not going to be too strong relative to the macro conditions. We don't have a reopening anymore. Some nations are still having a reopening. But just to talk about those World Bank outlooks, a heavy concentration, 70% of that downward revision is in emerging economies. And that's where I come back to strength, and it's where I come back to the stability of the US.
But from an investment standpoint, what about a place like Europe, for example? We keep hearing that it's cheap. So sort of the valuation, right? And things haven't gone as bad as expected. And then you hear about a name like Japan, and it's a bit different in terms of the storyline that investors are chasing. It is about corporate reform. It is about changes that are happening. How do you look at those two markets?
Well, I think Japan's very interesting. There's excitement around Japan I don't think I've seen over the last decade. To your point, it is about corporate reform. It's about population changes as well. Europe, I think, is still in a very tricky position. I don't think we can forget the fact that the borders of Europe are still at war. Ukraine is still a massive issue. There are still supply chain issues. There's still food security concerns. There's still energy security concerns, which no one's talking about now because it's a fabulous spring and a fabulous summer. When we go into the winter period again, and if that is not resolved, if there is no peace in Ukraine and some resolution around what Europe's energy sources are going to be, I think this is a very temporary piece of relief. I don't think we're out of the woods on that one.
And one of the big risks potentially here looming in the U.S. is what's going on in the commercial real estate market. We've been talking a lot just about the $1.5 trillion in commercial mortgages that are going to be coming due very soon. How big of I guess let's start broad here, just in terms of the threat that you think this poses to the U.S. market?
Well, in terms of the absolute scale, and it's sort of crazy to say this, $1.5 trillion is a lot of money, but in the grand scheme of credit in the U.S., that number is not an earth-shattering number, but it does point to something which I think isn't necessarily being talked about enough, which is, yes, you've got this issue in commercial real estate, you've got it in corporate credit too, which is a number of loans that were issued in the case of commercial over the last sort of 5 years, in the case of big corporations prior. These loans were issued in a totally different rate environment, and it was assumed that rates would continue to be low for a long time, and these credits were issued assuming that the cash flow of these businesses would grow. No one saw coming that so much cash would be consumed to service such a high cost of debt. So I think whether it's commercial, whether it's the consumer, whether it's corporate, there's a maturity wall that's going to hit over the next 36 months that's going to see people having to take on very expensive debt relative to their ability to serve.
What does that mean on the corporate side specifically when that debt payment comes due with those higher rates? What do we see?
Well, I think we're seeing it on the private side a lot more than we are in the public side. And so we're having to see businesses take out a little bit lower amounts of leverage, which means that their backers are having to infuse more equity. Or we're seeing that the terms of this debt, so whether it's the next generation of commercial loans or it's the next generation of corporate loans, are going to have tighter covenants. It's going to be a lot easier for the lenders to foreclose on those underlying assets. And so I think the terms are going to be a bit of a shake-up for any borrower over the next couple of years.
And is there anything that can be done at this point to fend off some of the risks that this does pose at this point?
I don't think there is at the moment. And here's what I think is so interesting about the market, and it's been consistent on this. The market hasn't listened. You know, there's that expression when someone shows you who they are, believe them. The Fed's been super clear. Our inflation target is 2%, and we're going to keep putting up rates until we hit 2%. And yet we keep seeing this optimism. And so one thing I think does need to happen is realism needs to set in, right? The Fed is going to keep going until inflation is at its target. The target, by the way, is not going to change. Europe's been consistent and on point in tackling it. The US is going to continue to do what it's doing. And so as a result, the underwriting has got to reflect the fact that rates are going to remain higher for a bit longer.
And Barry, as always, good to get your insights. And Barry, Threadneedle founder. Well, Merck taking legal action against the Biden administration over the Inflation Reduction Act. We've got Yahoo Finance's Anjali Kamlani following that story for us. What are the details, Anjali?
That's right, Akiko. We know that the drug companies have been gearing up for a battle against the imposition that the Inflation Reduction Act has on drug pricing. That is what the government was able to pass in order to allow Medicare to, for the first time in history, negotiate drug prices with companies. Merck fighting back, saying that this is, quote, a sham and extortion, because the health secretary and the administration are allowed to select which drugs, and these companies are not voluntarily a part of this program. In addition, they're being forced to come up with prices that are 25 to 60% discounted from listing prices. And in their defense, in this lawsuit, they're citing the Fifth Amendment. We know that as the right against self-incrimination, but here it includes the part of which the government cannot seize private property without making a due compensation at the market value. This is the fight that they're pulling with the health department as well as the health secretary. And they've said in a company letter that this is really looking at the drug development over the years and incentivizing drug companies. And that is the portion that they're focused on, which is if the government continues to push for these set prices, it is going to de-incentivize companies who have invested trillions of dollars in drug development and have, sold, of course, we know billions of dollars in these treatments. But in that lawsuit, the context around this is really that Merck is just the first of what is expected to be a number of companies, especially big pharma, taking on similar action. The industry has largely been waiting for this to come through. As we know, the deadline approaches for these negotiations to take place this year. It's the first company, and Medicare accounts for 30% of drug spending compared to private payers. So that's why this is such a big battle. It's a huge portion of revenue that they're also looking at that could be impacted. So all told, this is where, the battle really is starting. Not unexpected at all, especially towards the end of the year. We expect to see, more verbiage from the health department and looking at what the baseline will be for negotiations. They've got draft guidelines out right now. And so we're going to start seeing that firm up more on the agency side. And as you can see already, the drug company is ready to battle back.
Yeah, Merck shares down on the day about 3%. Anjali Kamlani, thanks so much for that. Well, coming up, ports stretching from Seattle to Los Angeles disrupted by dock workers in the middle of a union or labor contract negotiation. We're going to hear how it may have a greater impact on the West Coast on the other side.
got a couple of big announcements here from the tech giant, and among them was this long-awaited headset that we're looking at right now.
We heard Tim Cook say specifically it's the first Apple product you can look through and not at. And we do have a price tag, $34.99. We're talking about $3,500, and that's going to be the real test for Apple. How many people are, willing to shell out that kind of money?
I think a lot of people are going to balk at that price. Apple recognizes that this is going to be a low-selling product for the time being, and then eventually they'll likely lower the cost of that. But as far as VR, AR goes overall, this seems to be the one that's going to get people the most interested.
I think they did a good job of positioning it in a way that a lot of different people could see, oh, maybe I could use that. That is, of course, until the price point hit, and then that's obviously a big concern. The question really for me is, what's the long-term wearability of the device? But that'll be a big question, is what's the long-term comfort, and then does it deliver enough value for that $3,500 price point?
$3,500 is a tough pill to swallow for anybody. It creates a difficult go-to-market, I think, but Apple is very good at delivering unique content in a very seamless way.
There was a bit of a decline coming into the opening remarks here, and then we really saw a big sell-off. That big down red candle, that came off on the announcement of the headset. Is that ominous? I think it's a little bit too early to tell you, but I think it's notable, too, that Apple had climbed to a record high just before that announcement.
A long-running labor dispute causing slowdowns at several key ports along the West Coast as unionized dock workers protest a breakdown in wage negotiations. More than 22,000 dock workers have been working without a contract since July, and now major retail and manufacturing groups are calling for the Biden administration to step in. Let's talk about where things stand. We have Mario Cordero, the executive director of the Port of Long Beach. Mario, it's good to see you here. Certainly a tough time, obviously, for the ports. We have heard reports of disruption, some terminals being closed, longer wait times. What are you seeing at the Port of Long Beach?
Well, today at the Port of Long Beach, Sienna, and first of all, thank you for having me. I can represent that all terminals at the Port of Long Beach, the 6 container terminals, are operating. There has been some coverage regarding some gate closures regarding the truck gates, but I can represent to you that the 6 terminals are operating. So I think hopefully we're moving forward in terms as the week progresses now.
I mean, moving forward, you hope things are going to go more smoothly. At the heart of this is still those negotiations that have been ongoing between the ports collectively as well as the dock workers union. They haven't been working without a contract since July of last year. Where do those discussions stand right now?
Well, again, the Port of Long Beach, we're not privy to the discussions between the PMA and the IOW, but I can say that, we have heard that, there was very positive movement to move towards resolution. There was a bump in the road here in the last couple of days. So we're hopeful that that's resolved and encouraging the parties to move quickly to try to resolve that issue. But I will say this, despite the protracted labor negotiations, cargo has continued to move here at the San Pedro Bay complex and here at the Port of Long Beach. So I think, as you mentioned when you introduced the show, these resilient workers have continued to work day in, day out.
Mario, there have been calls from the retail and manufacturing groups for the Biden administration to step in, considering that we haven't been able to get a deal yet. Do you think that's necessary at this point to help?
Well, again, it appears that there's an issue there that the parties have to resolve. And I think once this bump in the road, as I described it, this issue that they come to a meeting of the minds, we move towards resolution of the contract. So hopefully that's my optimistic view. But again, admittedly, this has been a protracted negotiation. But I think the important thing that we have to acknowledge is the cargo keeps moving.
The cargo may be moving, Mario, but we have heard several reports of more and more being diverted to East Coast ports. We had a chance to speak to Gene Soroka several months ago over at the Port of LA, saying that, look, we don't expect some of that to come back to the West Coast ports because there have been concerns about a labor shortage, the kind of things we're seeing play out right now. I mean, what are you seeing at the Port of Long Beach, and how much of that you think you'll actually get back from the East Coast?
Well, over the many years, there has been diversion of cargo to the East Coast and Gulf Coast ports. I mean, they had their respective infrastructure investments. They have options for the shippers. But I think, again, we're hopeful that once the resolution moves forward of this contract, we will have confidence again in the American shipper in the San Pedro Gateway, because at the end of the day, this gateway it's in close proximity to the most important trade route of the United States. So, and as we continue to move forward with transforming our operations, as you know, the Port of Long Beach has spoken about 24/7 operations, or at least having a framework. So we will continue with that assessment as we move forward to continue to give confidence to the shippers that this is the gateway that's not only most important, most strategic, but we're going to move things with velocity and efficiency and meet the expectations of the shipper once this contract resolution comes to finality.
Well, Mario, how do you get that business back? Because there has been some talk that some of these drawn out labor negotiations, the fact that we haven't seen a deal, that it's hurt the reputation about the reliability of your port.
Well, I mean, no doubt there's that perception, and I'm not going to be dismissive of that. But on the other hand, keep in mind, Shauna, this is the same gateway that in 2021, we moved 20 million containers together with the Port of LA. And in 2022, 19 million plus. So no other gateway comes close to moving half that. So I think, again, the shippers do have options, and this has been a matter that has developed over the many years. But on the other hand, I think we have to focus on the fact that how do we move 20 million containers without congestion and bottlenecks? I think we have well progressed since that worst scenario a year and a half ago. And at this point, there is no congestion, there are no bottlenecks, there's no vessels at anchor, and the cargo is moving. So we will continue to be competitive as we progress forward.
Mario, you've always got a good pulse on the broader economic picture, just given the Port of Long Beach, Port of LA being the largest ports in the U.S. When you talk about shipment volume, what does that tell you about the demand picture and where things are moving right now?
Well, we have seen in the last month that the consumer demand has grown. It keeps a robust consumer demand, although, again, there's a lot of spending on services. So the economy at this point, we could say we have vitality in this economy. A year ago, people were talking about a big recession, and I think we're now talking not only a soft landing, but I think we're going to be pretty stable. The latest CPI number that came out for the prior month, we're at 4.9%. The next May figure is going to be announced next week. So from an economic perspective, we're doing pretty good as a nation. And so I think with that, we will continue to prepare ourselves to meet that consumer demand. And of course, focus on efficiency, velocity, and predictability. And if we continue to focus on those three elements, again, we will be confident we will remain very competitive in this containerized trade.
All right, Mario, we will continue to track these labor talks. Mario Cordero, great to have you, Executive Director of the Port of Long Beach. All right, well, coming up, Wedbush initiating coverage on some big names in the travel and mobility space. The analyst behind that call tells us why he sees Booking.com and Uber as his top picks. We'll be right back.
Leisure destinations are well above where we were pre-pandemic. Urban markets that have some leisure element, New York's a great example of that, well beyond. There are some markets, San Francisco comes to mind, that are still working their way back.
Obviously, a big pickup, you've probably heard, in international travel this summer as international trends have come back. So lots of demand domestically, lots of demand internationally. Still not all of the airlift back across the world, so still some tightness in supply and air. And, unfortunately, that means prices are going to stay high for the summer.
Chief executives of Marriott and Expedia among a long list of travel CEOs recently telling Yahoo Finance that demand remains strong and the industry is set up for a strong summer season. Wedbush is out with a new note on the sector with a list of names that they think are best positioned. Joining us now is the analyst behind that note, Scott Devitt, Managing Director of Equity Research at Wedbush Securities. Scott, it's good to see you just initiated coverage on a number of online travel and mobility stocks. Let's start with the online travel names. Who do you think is best positioned in this environment and why?
We like Booking the best. The travel industry's gone through a deep decline during the pandemic, a recovery today. You listen to the executives talk about how the recovery continues to be strong. There's going to be a point in time where that no longer is the case. And you want to own best-in-class assets. And what I mean is travel industry is a GDP-type growth industry. Online travel, which I cover, is faster growing, but it's a very high penetration rate. And so the overall growth rates under normal circumstances are relatively pedestrian for a growth industry. So you want to own these high-quality businesses that are cash generative, that are buying back a stock along the way, and that is Booking. Our second favorite idea, but a neutral rating at the moment because we're just waiting out this period, would be Airbnb. It's a very well-positioned company for the long term, but the challenge that Airbnb faces is that consumers during and coming out of the pandemic were looking at longer stays and more non-urban locations, and now they're looking at shorter stays in urban locations, which more favors traditional hotels.
So, let's go back to sort of those two names, because I was going to ask you with something like Booking, how much of it is about having a platform that has a number of verticals, probably not the right word, but a little more diversified in their offerings. Airbnb, we're talking about specific stays, and it is about stays. Where you look at something like Booking.com, maybe it's about being able to plan out your entire vacation there.
That's true. And you have a very diverse traveler with Booking, in that 85% of the stays on Booking are outside the US. So it's more traditional hotels. About 70% of the bookings on Booking are traditional lodging versus alternative. And then you have that international dynamic, which, as you've heard from executives in the industry, international is earlier in its recovery, which we think positions Booking quite well as well.
Scott, are you seeing signs of normalization? And I guess, where are you seeing a bit of a slowdown or a bit of us just getting back to where we were pre-pandemic?
Well, you can see it in a few places. The most recent data that we've looked at shows that revenue per available room night for alternative inventory has declined year over year in the month of April. And traditional hotels still had modest growth in April, but alternative began to decline. In addition to that, you have this dynamic of year-over-year growth rates because there was such a roar and rally coming out of the pandemic from a low base that from a percentage standpoint, growth rates were very high, for the first year to really year and a half coming out. We're getting to the point now where you're comping much stronger numbers. So the second quarter of 23 is going to be the first quarter where you have, relatively low rates of growth versus what we've been seeing. That's going to continue through the remainder of 2023. And by 2024, the growth rates of these companies are going to look more like they did before the pandemic. That's going to be an interesting test for the stocks, and that's why we're relatively neutral on the group.
Scott, one more name you're watching in the travel space is Expedia. You've got a neutral rating on that, $116 price target there. How is that different from somebody like Booking Holdings if you're talking about having diversified assets that are being offered on their platform?
So Expedia is more US-centric, so the company's benefited already from the recovery in the US, and so they're not as levered to international as Booking. There's been a long history of Booking outperforming Expedia. And in fact, in terms of total gross bookings since 2019, booking is up 55%, whereas Expedia is flat. So that kind of highlights the strategic differences and the competitive differences that have favored Booking versus Expedia. Having said that, if travel holds up longer and the strength continues through the summer, into the fall, and into the winter, Expedia is a statistically inexpensive stock. It trades about 5.5 times EBITDA on 24 numbers. So even though it's not a name that from like a growth and longevity standpoint that we tend to favor, we could see the stock move higher if the travel conditions hold up for longer than investors expect.
Scott, moving over to your mobility coverage, Uber is your top pick in that space. You have an outperform rating on that stock. It certainly has been a leader now for quite some time. What do you see as the catalysts here for Uber for that continued long-term success?
So Uber is in the 10 largest GDP markets in its ride-sharing business. It is number 1 in 8. In the delivery business, in the 10 largest GDP markets, it's largest in 6. So it dominates the U.S. market relative to its peer Lyft. It performs very strongly outside the U.S. in rideshare. There were questions about the viability of this business model before the pandemic. Investors questioned if it could ever be profitable. And now you have a business that's trending towards 2024 with the ability to generate between $4 and $5 billion in free cash flow. In addition to that, there's the delivery business that I would argue that DoorDash probably does a better job in the US than Uber Eats does. But when you look at that business holistically in terms of the international markets that Uber does well in, and the fact that Uber has a wrapped loyalty program, meaning that you subscribe to Uber One, you get benefits for ride sharing and delivery, which is unique relative to its peers. And now 27% of total bookings are in the Uber One program. That's a unique competitive advantage that others are not going to be able to match, and it positions the company well for the long term. So the stock's done very well, as have most of these stocks over the past 3, 6, and 12 months. But we are looking for blue chip, cash flow generative, competitively advantaged companies in an environment that we think may flip from tailwind to neutral to headwind in the next year, and Uber passes that test on the mobility side.
So let's take one of those factors that you just highlighted, competitively advantaged. When you look at a name like DoorDash, they certainly expanded beyond sort of their standard food delivery, restaurant delivery. They have grocery delivery. They've expanded into helping small businesses too. Where do you think they stand in that broader landscape right now? How much of an advantage do they have?
They have a very strong management team and a very good product. What they don't have yet is proof that the standalone entity delivery business is a good or high margin business. They're still in the process of proving that out. Whereas, as I mentioned with Uber, you've got that tied to a ride sharing business that's already proven cash flow capability in global scale. So DoorDash, to me, has potential to be, a blue chip company over time, but it still has a way to go to prove it, more similar to Uber's business, predating the pandemic. So we'll monitor it and love the product and the management team. And like I said, I think they do better in the US than Uber's Eats business competitively. So it's a company with a lot of potential, but maybe a little bit too early for us given the designation, that we're looking for in terms of the types of businesses that we think will outperform from here.
All right, neutral rating on DoorDash, price target of $75. Scott Devitt, great to have you. Thanks so much.
Thank you so much.
Well, restaurant businesses are gearing up.
I was just smiling on camera.
Restaurant businesses are gearing up to go public. The latest Twin Peaks on Tuesday, the chain Fat Brand saying it plans to pursue an IPO of that business. Brooke DePalma is here with the details. We're talking about a thawing of the IPO freeze, yet another restaurant.
Yet another restaurant, and now Fat Brand's looking to take this specific business, Twin Peaks, public. Of course, it's a sports bar, it's a restaurant chain. It primarily looks like a lodge. It was founded in 2005 in Texas, but then Fat Brands acquired it back in October of 2021 for $300 million from investment firm Garnet Station Partners. Now in 2022, it saw same-store sales increase by 11.3% year over year. As far as the timing and the exact size of the IPO, well, the company said that that's subject to market conditions and other factors. But what we do know is that FAT Brands will remain a majority owner. Now, Rob Rawson, FAT Brands co-CEO and EVP of Capital Markets, telling Yahoo Finance why now is the right time. He said, quote, "Twin Peaks is the crown jewel of our portfolio. With our strong net margins and development pipeline, we are confident the chain will bring investor value for years to come." Now, of course, FAT Brands is mostly known for other brands, including Fat Burger and Johnny Rockets. But as Akiko noted, this is just one of many restaurant chains looking to go public this year.
Well, speaking of that there, Brooke, we did get some of the terms set from Cava for their upcoming IPO. There's been a lot of comparisons drawn between Cava and Sweetgreen, and we know Sweetgreen hasn't performed too well. I guess, how did the two stack up, and what can we expect, do you think, from Cava?
Yeah, well, let's take a closer look at how Sweetgreen has performed since its IPO. It surged in its public debut. It went up to about $52 after its public offering. But as you can see here, shares of Cava, they're planning to offer 14 million shares. They're set to price between $17 and $19 per a share. No timing on yet it exactly will go public, but it does plan to list on the New York Stock Exchange under Cava. And if you take a look at shares of Sweetgreen now, well, they're about down 80% since their IPO offering back in November of 2021. They're sitting about nearly $11 per share here. And similar to Cava, Sweetgreen continues to struggle with profitability. We heard in the last quarterly results that we continue to gain sales momentum, and we see profitability with Reach. Cava also struggles with profitability, but this is just one company yet again looking to go public. We have others including Panera Brands, Korean barbecue chain Gen Restaurant Group, as well as Brazilian Steakhouse, Fogo de Chão. And so ultimately what we're looking for here is why exactly they're looking to go public. Well, CEO of New Construct, David Traynor, said that these companies are going public now because the market is willing to price them so high. So something interesting to take away there.
David Traynor, who, by the way, said that he doesn't expect a very strong
Yeah,
showing.
he does not. He does not.
We'll see. We'll find out.
Was it a catastrophe? Like a catastrophe?
Oh, you didn't use that one with us.
There you go. There you go. I can just imagine the puns that are about to come. All right, Brooke De Palma, thank you so much. Coming up on the other side of the countdown to the closing bell, we're going to check in on some of the top trending stories of the day.
The best way to think about this intelligent data analytics platform that is Toggle is that it sits on a very large mountain of data, and it's constantly giving a number of these assets a daily health check. There's so many things that you could look at as to, do you have fever today? Are you coughing and so on? And same things happen in the market. We would struggle to go through everything every day, read the Fed statement and so on, but computers don't. Mm-hmm. And so then they can summarize in a few bullet points the three things that you should pay attention to today. ChatGPT is, of course, in the limelight because everybody is now learning how to use this technology. What we have taken is foundationally the same model, but we've trained it specifically and much more narrowly on financial analytics.
Microsoft announced with us last week at their Build conference the idea that a lawyer can go into Microsoft Word and can use a large language model, so an AI model, to auto-generate the first version of a contract, and allows an attorney to, in real time, make the edits and ensure that that draft contract is perfectly accurate and ready for prime time. I think enables a lawyer to do in seconds what previously may have taken hours to do. Our view of this is it will enable lawyers, no matter what their tenure, to get to the fun stuff, to get to the more interesting problem solving, to get to the work that adds value to their clients. And we think that's a really healthy step forward for the profession.
And there you have it, the closing bell on this Tuesday as we look across all the majors here. Green on the board as we see the Dow closing up 10 points. The S&P 500 up 9, hovering pretty flat there, and Nasdaq up about 46 points. In terms of sectors that we're watching today, energy, or I should say financials, one of the biggest performers or biggest gainers on the day. That sector up about 1.3%. Of course, crypto, another one that we're watching very closely, Shauna, on the back of what we saw out of the SEC.
Certainly is. And one of the losers of today is Coinbase on the SEC clampdown here, closing in the red. The crypto exchange facing a lawsuit from the Securities and Exchange Commission, the SEC alleging that Coinbase violated rules that require it to register as an exchange. We're looking at losses of about 12% on the day, off 20% in the last 2 days. And that's because this is the second case brought by the SEC against a crypto exchange targeting Binance yesterday. So once again, losses across the board. And of course, this brings up the question, just what exactly regulation could potentially look like in this space and what this does here for crypto and investor interest in crypto down the line.
Yeah, I mean, there's a number of threads going here. One, we have certainly seen sort of the very strongly worded statements coming out of the crypto industry to say essentially that when you go after these exchanges in this way, that could stifle some of the innovation. We also had our guest earlier, Kavita Gupta, saying, asking that this actually raises more questions. If you think about some of the tokens they went after, Solana, Cardano, Polygon, why these specifically? And by the way, her point that she made is that these were on Coinbase. They were listed on Coinbase when they went public.
Mm-hmm. Yeah, certainly. And brings up a lot of questions, just exactly why now, why they are targeting Coinbase. You mentioned some of the strongly worded commentary coming out here from the industry. Coinbase's CEO, Brian Armstrong saying that the SEC complaint is part of a, quote, an enforcement approach that is harming America. And that pretty much sums up how many in the crypto world are viewing the crackdown here from the SEC.
Okay, let's move on to another story we're watching right now. Shares of Molson Coors moving higher after Bank of America Securities upgraded the stock to neutral from underperform. The analyst noting Molson Coors' U.S. market share gain as a result of the Bud Light boycott. Of course, it's a story that we've been following very closely there. When you think about what specifically they've highlighted here in that report, they say it's difficult to determine the duration of the boycott on the back of the influencer who was transgender, but they've already started to see some of the market share gains that Molson Coors has made.
Yeah, they're starting to see it reflected in the sales, and they expected to see it reflected in earnings that are coming up because some people who have decided to boycott Bud Light, they are turning to some of the offerings here from Molson Coors. When you take into account Coors Light, Keystone, Miller Lite, some of the offerings there that people are using as an alternative to the Bud Light boycott. When it comes to what this analyst is saying, he's saying that TAP is likely to service the demand spike due in part to some of the supply chain improvement that the company had made on the back of some of the troubles that it did have during COVID. So they are able to meet that demand, the rising demand that they are seeing from the boycott. But when you take into account how long this boycott has lasted, and Bank of America pointed that out in this note, it's lasted a heck of a lot longer than many on the street were initially.
Well, they're saying we're going into another big holiday, July 4th, and that could have a big impact as well. Another story that you're watching, I keep taking your
watching it. It's Boeing. Look at that. Shares closing off just about 0.7%. The company warning of a new defect on the 787 Dreamliner planes. As a result, the company is saying that it will delay deliveries of the aircraft. Shares closing lower for the day. And Akiko, this is just the latest of a long list of setbacks here for Boeing. They have had a couple of problems with defects that have forced the company to halt their shipments of the Dreamliner over the last several years. So certainly not welcome news among investors.
Yeah, and we're looking at this from a stock perspective. Obviously not good, but there is the question around confidence around Boeing planes as well. The company specifically saying they're inspecting inventory for 787s right now for what they have described as non-conforming condition related to a fitting on the horizontal stabilizer. Either way you look at it, certainly not good news for Boeing, and you do wonder how much that delay is going to last.
Yeah, certainly. Shares closing off just about 0.7%. All right, another stock that we're closely watching, and that is Apple. On the heels of Apple's headset Vision Pro marking the first new major product since 2014, bringing the tech giant into the mixed reality space. But what does Apple's presence mean for some of the other players within the market? Here to break it all down, Yahoo Finance's Dan Halley. And Dan, the name that everyone keeps bringing up is Meta and their efforts already within this space. So how did the two stack up, do you think?
It's night and day. I mean, it's wild how much better this is. Akiko and I were talking about this earlier.
You actually got to try it.
Yeah, I got to try it on.
I
mean, it was wild. I mean, the visual fidelity, the capabilities, the control. I took that picture. The controls. It's second to none. Meta's got to be seething at this point. Mark Zuckerberg spending tens of billions of dollars on the Meta Reality Labs segment, and for Apple to come in and just kind of swoop in, get the limelight, and prove that they have better technology right out of the gate. I mean, you got to imagine that Meta is just losing their minds right now. And I mean, to try it on is, I could sit here and just discuss it, but once people are able to finally try it on, I mean, it truly looks like this. We were talking about before how a lot of times when you see headsets like this, it's cool, it's CGI graphics, and then you put it on and, oh, this looks pretty bad. This you put on and you're like, oh my God, it does look like that. I'm an admitted skeptic. Headsets just don't really do it for me. And I tried it on and I left slack-jawed.
And so, I guess, the question is it fair to compare what Apple has released to what is about to come from Meta, which is the Quest 3? I mean, the price point alone seems to point that Meta's product will be a lot more accessible. Mm-hmm. Maybe not the top-of-the-line technology, although you haven't tried that out yet. Mm-hmm. Is this kind of a situation where we start to see the divide like smartphones, where it's the iPhones, the premium brand, and then you've got Androids? I
think that's exactly it. And what Meta is going to do is say you can get an AR, VR experience, because the Meta Quest 3 is going to have AR elements. There's a see-through, full color see-through experience. They're going to say, look, you don't have to spend a fortune to try this new technology. You can see the cameras there on the front. You can get the same kind of experience, or not the same, but a similar experience with us at a cheaper price. And you don't need to get specific lenses. If you use the Apple one, you're going to have to get prescription Zeiss lenses if you can't have trouble seeing things at close to you. And I mean, it's going to be something where they are going to lean heavily on the fact that we have this ecosystem of apps already. We have the hardware already. We have, we've proven to a degree that people are willing to go out and buy this. The issue that both of them have is there's no killer app. There's nothing that makes people say, I'm going to buy this, and then it's not going to be a paperweight that costs me hundreds of dollars or thousands of dollars down the line, right? I mean, I think there was a quote that a few months ago that The Verge had gotten from an internal meeting at Meta, where they had said, people aren't using this long enough. They get it, and then they just kind of ditch it. And I think that's the issue. I don't buy a Nintendo Switch and leave it to sit there. I use it.
But isn't the key with Apple the usage across the products. So you talked about that, having the headset on and then being able to pick up on what's on the MacBook Pro. I mean,
Right.
I've got the iPhone, I've got the watch.
And I think that's one of the things where, Meta's been trying to, and, Microsoft tried it with the HoloLens. Meta's been trying to push the enterprise experience, where you can hang out with your coworkers as avatars and everything. Nobody wants to do that, right? Like I don't turn my camera on for a reason. I don't want a virtual version of me to be there either. What Apple is doing is exactly, as you said, tying it into the broader Apple ecosystem. So there was one demo, and unfortunately they didn't have this there when I was trying it out, but you would look down at your MacBook and then the screen would explode, not like explode, but like blow up into a giant, like 100-foot MacBook display, right? So everything on my MacBook is now on this, massive screen that I can then use a Bluetooth keyboard and I can do all my writing, and it's being powered by the MacBook. So it's not relying on the power from the headset. I could do video editing. I could, do tons of research, grab this thing, move it over here, and I have this over here. I'm watching this movie. I'm bringing this into, this dock. So that really is a powerful, perhaps worthwhile experience. Now that they have this or are getting it into developers' hands, give me something more. For $3,500,
Yes.
Give me something more.
Would you pay $3,500 for how it is now?
I was saying to Kiko before, I'm balking at the price of the Air. Yeah. And that's like, what, $1,100-$1,200? So what do you think I'm doing with 35?
So
I'm
it needs to come down a little bit.
Just drop the price a little bit.
Yeah. Well, it looks cool.
It does.
Great job
amazing.
out there. You were a one-man band out there, did incredible stuff covering all of that for us. Dan Halley, thanks.
Thank you.
Well, keeping the conversation going here, could Apple's Vision Pro headset be the push needed to take the metaverse mainstream? Joining us now is Jeremy Bailenson, a metaverse enthusiast and Stanford University professor of communications. Jeremy, to call you an enthusiast is probably understating it. You have been studying this technology for years. You teach a course in virtual reality. Your first impression on what Apple launched yesterday or unveiled yesterday?
Yeah, thank you, Akiko. And I am a VR scholar, and I spend all day thinking about and working in VR. That being said, I'm not an enthusiast. I believe VR is an amazing thing for very special experiences. I'm not a person that believes you should use VR every day or for hours per day. We in the lab, we use VR for things that are dangerous to do in the real world. For example, training a firefighter, or impossible, changing your body to understand walking a mile in another person's shoes. We don't believe VR is a tool that you should use for everything. So I love VR, but I don't love VR for everyday, hours per day use. I think it's a different kind of medium than people are used to.
Why not, Jeremy? Just expand a little bit more just about why you're not a fan of that prolonged use and maybe some of the risks that you see associated with it.
Yeah, so when we talk about the downsides of VR, we talk about, first of all, simulator sickness. Of the reporters who've tried it, Dan, sounds like you had a great experience, but a few people that I've talked to after 15, 20 minutes were feeling a little bit dizzy, a little bit wonky. We talk about being distracted from the real world. So how does a family dinner change when I'm sitting at the table wearing these goggles and, I can't even make eye contact with other people because, I'm wearing these goggles. And so, which is not to say to vilify the medium. I love VR, I love AR, but it's not something like a phone. A phone has engagement that we use for hours on end. VR is perceptually taxing. It distracts you from the real world, so we should save it for experiences that are special. And to give you an example of that, my company Striver, we're in every single Walmart in the country, we're in every single Bank of America, and employees, they go in the back room and they train. They put on the headset, they practice having a difficult conversation with someone else, they figure out what to do when an active shooter comes in the room, how to move their bodies, and these are really intense, rare experiences, but they pay off. And I always say VR is an amazing thing for these kind of dangerous, impossible, intense experiences. But if you're reading your email in VR, you might as well just be using your phone. I just don't get why we need to see 2D screens while wearing a headset.
But Jeremy, that point that you just made, not being able to make eye contact in VR, not being able to see what's around you in VR, doesn't that point to why what Apple announced yesterday could be that next level? We have heard for years that it's not about VR, it's about mixing reality with AR. And that's what
from
Apple
a technological standpoint, I love that they're including other people. I love that they're showing other people my eyes and that they're highlighting third people in the room to bring them in. That's all fantastic. That being said, all of us have experienced being at the dinner table someone who's on the phone instead of being engaged, and what's going to happen when you see that beautiful landscape behind you and we're trying to have a conversation together. So I believe they pulled out an amazing technological feat. The question becomes, as we think about development and all of the money Apple and others have spent on trying to make VR into an everyday device, just because we can be doing this daily doesn't mean we should be. And all of the research we've done in the lab, you mentioned that I taught an entire class in the metaverse where we had over 600 Stanford students have spent about 500,000 shared minutes together in VR. And we know what works and what doesn't work. And the answer is less is more. VR is amazing when you're using it sparingly, even when you've got great technology, because we've got technology in the lab that's different from the consumer grade. Just because you can have this really immersive experience doesn't mean you need to do it every day. And it's going to be a challenge for the technology companies to get a return on investment once they realize that, the philosophy, Dan, that you talked about, we're going to see what the developers can come up with. I like that thinking, but we've had about a decade now of developers coming up with stuff, and there is some amazing stuff, but there's still quite a dearth of content that's engaging, and it's going to be a challenge.
Jeremy, do you think Apple is going to change the conversation around AR and VR? Because I think one of the biggest obstacles when it comes to VR is people have such a tough time wrapping their heads around exactly what this means. Now that a name like Apple is now ventured into this space, I guess how receptive do you think the general public is going to be to a device like this?
Look, we've all got to try it, and Dan had a great experience, and others I've talked to have had. There's been a range, but I've been in the VR space for 25 years now, and I've seen headsets come and go, and I've seen big names come and go. Google got in, and arguably they got out, and I don't know the answer to that. I do know that more than anyone, Apple's got a dedicated enough user base that they can solve this chicken and the egg problem, which is you get enough people in there, people want to do that simply because they're familiar with those icons and those apps and content. So they certainly have that advantage. That being said, I'm fairly jaded from 25 years of one magic headset going to cause VR to go from a thing that should be done for special occasions to an everyday engagement tool. I just don't see that.
I mean, with that said, does Meta's approach make more sense? I mean, we're still waiting on the Quest 3. The price point alone would make that product a little more attractive. We don't know how the technology compares to Apple, but they seem to be pushing for an experience that really is completely virtual and maybe not as seamless as what Apple has.
Look, it really depends, in my opinion, on your philosophy here. So when you use VR, complete mental transportation, you can have an educational experience that inspires awe where you travel somewhere, you can go back in time. You can, as I said, change your body to understand what it's like to be a different age, different skin color. You can have a training situation where you really feel like you're there and you practice your body movements. That's a philosophy of immersion and mental transportation. What Apple's trying to do, and to some extent Meta's trying to do this too, is how can you make it so that people can see the real world and spend lots of time in there? I will say that despite a lot of great rhetoric and great video presentation, there's nothing that Apple was doing other than great implementation that others aren't trying to do too. They just have, like they tend to do with products, have just done a crushingly good job on the technology itself.
Okay, Jeremy Bailenson, always good to get your perspective on this. Stanford Professor of Communications, appreciate the time.
Thanks for having me. Have a great one.
Well, coming up, Elf Beauty Chairman Tarang Amin joins Yahoo Finance Live to weigh in on the state of the beauty industry. We'll be right back.
Sotheby's is known for generating eye-popping sales across a range of ultra-rare art, luxury goods, and property. The streetwear and modern collectibles arm of the business is now the platform for the sale of what it's dubbed the Dynasty Collection, which consists of one Air Jordan shoe from each of Michael Jordan's 6 championship-clinching NBA Finals games. Yahoo Finance had the opportunity to go hands-on, with white gloves, of course, to discuss the shoes once worn by His Airness.
What's going on, everyone? Yahoo Finance here with Ram Wachter, who is Sotheby's head of streetwear and modern collectibles. Talk to us about your segment within Sotheby's. What type of growth have you seen?
So Sotheby's Luxury as an overall did over $2.3 billion in sale last year. Streetwear and modern collectibles did about $50 million, and in our offerings, about 90% of the lots were sold.
Who are the buyers that you hear from and the interest that you hear from as well?
Our buyers typically are younger, so they typically range 20 to 40. They're sort of titans of industry, so usually successful in finance, successful in real estate, advertising, marketing. They have either a passion for sports memorabilia, collectibles, or they just have a passion for dead stock sneakers.
So say I did walk in off the street, I saw this exhibition, I said, Ram, I want to purchase, like here and now, today. How much do I need to be ready to potentially pony up?
Obviously, we've got 6 unbelievable sneakers here, and so, the sky's the limit. We've noticed that in terms of sports collectibles, over the last year, even given the economic turmoil, at a high level, the market is doing really well. We sold, less than a year ago, Michael Jordan's jersey from Game 1 of the 1998 NBA Finals for $10.1 million. Shortly thereafter, we sold a LeBron jersey from Game 7 of the 2013 NBA Finals for $3.7 million. And then we later sold a Kobe jersey for just about $6 million. And so what we're seeing is for the highest end collectibles, for the best sports memorabilia, and really the most iconic moments of different athletes' careers, the market really has been quite strong. And we haven't seen really a sign of that slowing down.
Consumers continue to face a challenging economic environment amid rising rates and elevated inflation. Countless retailers have pointed to the choppy consumer environment, yet there seems to be a bright spot in cosmetics. For a closer look into the state of beauty, the beauty sector, we have e.l.f. Beauty Chief Executive Officer and Chairman Tarang Amin. Good to talk to you today. It was the thing that we heard over and over, especially from some of the big name retailers who are saying consumers are still buying cosmetics. You're at a competitive price point. What are you seeing as consumers have to face higher prices and have to kind of prioritize?
Well, I think we've been really fortunate, and I'm proud of our team. This was our 17th consecutive quarter of net sales growth. We finished our fiscal year with net sales up 48%, grew over 270 basis points of market share. So our business is really resonating with consumers. And I think what you're seeing in the macro is I'm quite bullish on color cosmetics and mass beauty. It's one of those small luxuries everyone can afford. And we're particularly well positioned within that category with our incredible value proposition of bringing the best of beauty and making it accessible, our powerhouse innovation, and our marketing engine. And it's definitely resonating with consumers.
Tarang and Shauna here, what are you doing, I guess, more specifically on that pricing strategy, given the fact that inflation has remained very sticky? How much of that have you or are you planning to pass along to your consumer, given the fact that it hasn't improved at the rate, or eased, I should say, that maybe we were initially expecting?
Yeah, so our model is different. We took pricing in March of 2022, so over a year ago, and that was in response to a lot of the inflationary pressures companies are facing. But since then, we haven't taken any additional pricing, and we do not plan to take additional pricing. We feel that if we can offer an extraordinary value proposition, it resonates with consumers. A great example is we recently launched our Halo Glow Beauty Wands. These sell for $9, but the only other thing you can find like it is a prestige item at $42. So we're able to offer our consumers an incredible value equation, and it's working. It's driving really strong sales, and that in turn is helping us expand our margins as we get leverage in the non-marketing SG&A portions.
To what extent are you seeing trade downs? I mean, maybe you don't want to spend $60, $70 on a certain product. e.l.f. offers something that's a lot more cheaper.
Yeah, so I think, more than even trade down or trade within, our unique proposition is our ability to expand the entire category. For example, 3-4 years ago, we introduced our poreless putty primer. This product costs $10, which is a little bit higher than some of our other e.l.f. products. But again, the only thing like it in the market is a prestige item at $56. Now, we've tracked that over time, and what we found is both mass and prestige beauty are actually doing quite well right now. That prestige item continued to grow double digits, but we brought 9 times the number of consumers into the franchise. We sold 9 times the number of units. So really our proposition is being able to give millions of consumers access to the best of beauty that they somehow couldn't afford. I mean, not everyone can afford a $56 poreless putty primer, but you can afford $10 for the e.l.f. one.
Well, Tarang, to that point, you have historically been very, very popular among the younger consumers, Gen Z. There's a Piper Sandler survey, and over the last several quarters, you have been named the top makeup brand among the younger consumer. As people do maybe trend down a little bit more, you talk about the fact that you're growing your market share. How much of that is coming from older consumers, and where are you finding that?
Well, as you said, we are the #1 brand amongst teens, and we have been for some time, not only by a wide margin in color cosmetics, but we cracked the top 10 with e.l.f. Skin as well. So our brand really does resonate with teens. But one of the things we've been seeing is we've been picking up more and more millennials and Gen X, and that really talks to the fundamental power of the value proposition, the innovation. You know, consumers that maybe would not want to find this beauty wand are coming new to our franchise, and we're seeing that we're picking up more than just the teens, and that's actually been a really good thing.
What are your top selling products right now? What does that tell you about what consumers are prioritizing?
Well, you know, a lot of our top selling products happen to be in the complexion area. So our Power Grip Primer, again, is not only the #1 primer in mass and prestige, but it's the #1 SKU in mass cosmetics. We also have real strength with concealers, our highlighters, our Halo Glow franchise. And so what you're seeing is e.l.f. Beauty is really great for that everyday look that you want to go out with. But people are also looking at some of these other core categories. We have a great launch with our O-Face lipstick, a real bold, satiny color. And so we're seeing strength pretty much across every one of our segments. We have 16 segments where we have the #1 or 2 position in the mass color cosmetics category. So we're seeing our brand resonate across multiple segments and multiple consumers.
Tarang, what are you hearing from some of your partners here? We heard from Walmart, from Target, that they're struggling with inventory shrinkage, specifically their ongoing organized retail crime. Are you seeing that, or are they seeing that with some of the e.l.f. products that they do sell in the store? And I guess, how do you think, or what do you think is the best thing to do, or the best way here to deal with this challenge?
Yeah. So I would say that's probably more of a macro issue than specific to e.l.f. We haven't seen it in a great magnitude, but I think the best thing we can do with our retail partners is continue to partner with them, bring the innovation that their consumers are looking for, bring the engagement model that I talked about, and the value proposition. And e.l.f. is a great value every single day, so we don't rely on high-low merchandising or any of those types of things. And what we find is it has resonance with every one of our retail customers. We're growing our business strongly at Walmart. We grew our business at Ulta Beauty over 70% last year without any incremental space. And at Target, our longest standing national retail customer, we're their biggest brand across mass color cosmetics and facial skincare by a pretty wide margin. So I think our value proposition, innovation, and marketing really are resonating despite any of the other macro issues they're facing.
Yeah, we're certainly in the right space right now in terms of the strength that we're seeing. e.l.f. Beauty CEO Tarang Amin, appreciate your time today.
Thank you.
Coming up, we go around the horn and check in on some of the top stories we are watching today. We'll be right back.
Let's take a look at some of the top trending stories of the day. We got Josh Schaefer and Pras Subramanian here to help us break it all down. We got to start with one of the big headlines out today, and that's a huge announcement that shocked the golf world. The PGA Tour and Live Golf teaming up. Josh, you have been digging into this story. You've been closely following this story since day one. This is a stunning announcement. You got to think a lot of those athletes, a lot of the golf players, extremely upset over this.
Yeah, it really is. So Live Golf was the new startup league that we've been covering since last year. It's backed by the Saudi Public Investment Fund, and what was announced today is a partnership between Live Golf and the PGA Tour and the DP World Tour, which is the European World Tour, World Golf Tour. And essentially what this deal does is it creates a new entity that is going to be funded by the Saudi Public Investment Fund exclusively right now, funded by the Saudi Public Investment Fund. And really what the take, I think, here is broadly is we have both sides doing what they said they weren't going to do last year. Live Golf said that the PGA wasn't good enough for it and they could find their own media rights and they could succeed on their own. Live Golf couldn't succeed on their own. They never even got a good streaming deal. And then you had the PGA saying, we don't need Saudi money. That's dirty money. We'd never go over there. We don't want our players going over there. Well, now they're taking that money. And I think that's the broad takeaway I have today, Akiko, is that you basically have both sides doing what a year ago they said they wouldn't do, and I'm personally just pretty shocked by the merger as a whole.
I think you're putting it gently. It is hypocrisy. I mean, that's kind of the bottom line of it, right? And you look at both sides. On the Live side, to your point, it was all about, well, we're offering competition here. There's only been one entity. And then on the PGA side, it was about the Saudis. It was about the 9/11 families. It was about, we would never go near that. At the end of the day, it's business.
Yeah, I mean, I look at it from the player's point of view. I got to see, I mean, some of them must have been like Rory McIlroy, must be dumbfounded by this move, kind of shocked. They took a big stand against Live. But then it makes me think that, was the PGA scared that all the players are going to leave? Is that why they did this deal? Because we talked about this before, in player-run leagues like tennis and golf, you can actually kind of corner the market very easily in that. And was that the fear of the PGA? Was the players sort of all of them leaving? I don't know, but it's just a thought I had.
I don't know, because they were able to retain, at least for now, a lot of their top talent. You mentioned Rory McIlroy. He was one of the most vocal in defending the PGA Tour, criticizing those players who did decide to leave. He got in a couple back and forths with Phil Mickelson over the last several weeks. But when you take into account what's happening at the end of the day, I think a lot of people are asking what this will do to the game of golf. And there is argument out there. Jefferies was one of the companies that came out with an analyst note today saying that the sport in general is going to benefit. Some of the names like Topgolf, Callaway, obviously one of those best positioned to benefit from this. But I still have question marks just in terms of how much bigger we're really going to see the sport of golf grow, even if it does have all of that funding from Saudi Arabia.
Yeah, the take is essentially now there'll just be more money in the game, right? And I think at a high level, I guess you could say that would make the players more motivated, right? So then you can maybe have a longer season and you can sort of grow beyond the majors. That's where the PGA has really struggled when you think about why Live Golf came about. Outside of those four majors that we talk about, that includes the Masters tournament and the British Open, we don't really talk about the tour that much from a broad sports perspective. It's not as popular as some of the other major sports. So I guess the theory would be you get more money in, you get the players to be more interested in the offseason, and then it grows. I don't know, the market, I will say, those golf stocks were up today, up about 5% at one point. So it was interesting to see that people do sort of believe in maybe it is a rising tide there.
The Saudis coming out the biggest winners in all this.
Yeah, they certainly are.
Pivoting to something a bit more interesting in my world, Elon Musk.
You didn't like our discussion?
No, I think we could keep talking about it more and more. And I know Elon Musk also has his past with the Saudis as well in terms of taking his company private. So anyway,
a good way to connect the two.
Yeah, 420, love it. So Musk said he could be open to licensing some of Tesla's self-driving features. This after GM CEO Mary Barra said that it would be hard to find cheap EVs in the $30,000 to $40,000 range, profitable by the end of the decade, maybe even beyond that. So Musk said, hey, we'll do whatever it helps to make EV adoption come on here. We'll license our technology for FSD. We'll do things like that. We've already opened up the supercharger network, So Musk, says he's very charitable here, but, they're licensing that technology. They want to make money off it. They want to keep the data on that.
My first question was in this. Do you want to license this technology? If you're a competitor, when you consider the problems that Autopilot has had.
Right.
Do you want that technology integrated? I mean,
FSD, right, for all its issues, it has been improving slightly, but it's still under full NHTSA investigation for safety, right? This is a kind of a software that has a kind of a cloud around it. And of course, Musk says, well, we'll license you. We'll take the money.
I mean, it is interesting. I think that speaks to sort of how Elon Musk has evolved around this. We talked about the recent partnership with Ford. He's sort of opening things up because the competition is increasing, right? And there are other channels for revenue. Is that the way to look at it?
I mean, it's a pure, I'm such a good guy, but let me make some money off you too, right? That's the way I see it.
Or is it also just the fact that maybe Tesla is in a little bit more trouble on the demand side of things than many have really taken into account or realized at this point? We know their profit margins have been under pressure now for a couple months as Musk has lowered the price of their EVs in order to entice some of those buyers. So now he's exploring even more avenues, new avenues here of revenue. Paints maybe a dire picture. I don't know.
Well, I don't know, because I wonder how much they've been looking into this all along, right? And when you think about what the value prop has sort of been for Tesla from the beginning, would be that they were the initial runner in the EV space, and then people are going to want to buy their tech, they're going to want to use their chargers, they're going to want their battery packs. So sort of creating that overall EV world. And maybe they've been operating like that all along, and Musk I feel like sometimes when Musk tweets these things, he just wants you to remember that it's a possibility. He's like, hey, we could sell this, by the way.
I do wonder, the other consideration, and I'd be curious to get your thoughts, is that it is such a crowded space. So we're focused on Elon Musk because Tesla has been the leader in the space. But at the end of the day, does there need to be more collaboration? Because the question for long has been, can all these car companies survive anyway? Is there a way to improve the technology, bring down the cost, and does that require more collaboration?
I think it was Doug Field, former Apple engineer now at Ford, said this is going to be the hardest problem in our generation to solve is autonomous driving. So it is a big issue that maybe multiple companies should come together to figure out. But if you're Tesla, you would love to license this technology. I mean, they want to hit 80% margins on that. What better way to do that than to have another company just pay for your technology? So I think that it's a pie in the sky, I think, for him to think that GM would want to pay for that. But we saw Ford, they shut down Argo. They would be another potential partner there for that. So we'll see.
Okay, we're going to end on a fun story. The battle of the fried chicken sandwich. Popeyes bringing out another blackened version. By the way, we should correct this because my understanding is that the blackened chicken is not necessarily fried chicken. I got initially excited when I heard this. The fried chicken's the best part of Popeyes, right?
Well, blackened chicken is never fried chicken.
It's Cajun, right? It's Cajun
blackened.
blackened,
It's like the blackened seasoning.
I love blackened.
It would have been great with fried. That's what they should have done in Kiko. That's
need
why
the
I'm not that big of a
breading
fan.
on the top.
I just think it
That's what
should.
makes it
Do they have a buffalo chicken sandwich?
Yes, I'm on board with that idea.
The buffalo chicken sandwich, that could be the key. It's just amazing to me, and I love talking about this, but just how many people out there love fried chicken sandwiches and why this is this new revelation over the last several years. What is it that all of these fast food giants decided to enter the fried chicken sandwich wars? We're talking about time and time again. They sell out every couple of months. They come out with a new product in order to up the ante once again, but people can't get enough of it, and it's evident from the sales.
Is it the Chick-fil-A sort of like the expansion of that business? Like, in the South, obviously very popular, but then it started expanding more and more. Like, oh, we love fried chicken sandwiches. Oh,
I'd be curious to get a map of where the loyalties lie across America because I am Team Popeye. I'm very vocal about that.
Popeye started the war, right, with the spicy chicken sandwich.
I like the Chick-fil-A waffle fries, though. The Chick-fil-A waffle fries are good. The Chick-fil-A sauce is good. Chick-fil-A's not open on Sundays, so it's hard to be that loyal of a customer, right? Because sometimes you want it and they're not there for you.
Have you guys ever tried the Burger King chicken sandwich?
Oh, I used to love that. I used to love that one.
It's my favorite order, hands
like a
down,
sub.
of any
It's like a
item.
sub.
Of all
of any item on a
When I was
fast
a kid,
food menu.
I used to eat
across
that
the
as a
board.
kid.
That's
I used to
a
as a kid.
fusion
The shredded lettuce.
Shredded lettuce, the mayonnaise that they put on top of it, perfectly cooked. It's so good.
I will say Popeyes is very consistent. I can't tell you how many Popeyes I stop by. Every time it is exactly crispy how you want it.
Yeah.
It worries me a little though. How do they keep it so crispy? Don't you wonder about that? Maybe we shouldn't really.
I'm going to go and do a taste test after this and I'll let you know, Kiko.
Yeah. Well, all right. I know. We should have brought some onto set. We got to do that soon to try it all out. And
we'll take a self-driving car there. And then
there
we'll
we
see how
go.
it
There
goes.
you
We'll
go.
have a
Tying it all together. All right, guys, we'll leave it there. But coming up next, J.M. Smucker CEO Mark Smucker joining Yahoo Finance to weigh in on the company's fourth quarter earnings. Don't go anywhere.
Well, despite seeing growth in all three of its business segments, J.M. Smucker's company forecasted a smaller than expected decline in annual revenue amid stronger demand for its ready-to-eat meals. Here's what CEO Mark Smucker had to say about the company's Q4 earnings earlier today.
I think at the end of the day, we're incredibly proud of our results. We've had 13 quarters consecutive of beating expectations, and we're poised for further growth as we just began our new fiscal year. We've executed our strategy exceptionally well, where we've made some divestitures, which have allowed us to focus on our growing brands like Uncrustables, obviously Dunkin', Cafe Bustelo, and notably our Milk-Bone dog biscuits, which are all growing very, very healthily as we move forward into this new fiscal.
Good morning, Mark. Brooke here. Let's break down those Milk-Bone sales. We saw sales grow 20% this quarter. Break down for us who exactly the audience is there, and are you seeing perhaps higher income customers trade into the Milk-Bones brand?
Yeah, sure. Actually, the Milk-Bone brand is a great example of a brand where we play across the entire spectrum of value. So we have our base core mainstream biscuits, which are very affordable, all the way up to our high-end dental chews, long-lasting chews, and then all different versions of our biscuits, which are stacked or dipped in various ways. And so just a very broad portfolio that highlights how we are going to market across our other brands as well, allowing the consumer to access products that they love, brands they love at various price points.
And Meow Mix, the demand there is actually outpaced production. Break down for us how you're exactly addressing this and when we can expect supply to meet that demand.
Well, you know, I'm so proud of our employees because throughout the pandemic, we faced a number of supply chain challenges that we overcame. This is no different. We are seeing demand for Meow Mix very strong, and the demand is actually outpacing supply. So we are right now investing in both infrastructure and labor to ensure that we meet that demand. We would expect to come out of this over the next 6 or so months, or slightly beyond that perhaps, but we are working to make sure that our supply meets demand on Meow Mix. It's just a fantastic brand.
And Mark, something that powers humans, of course, coffee. You've got to talk about the coffee play here, especially with Folgers. Talk about that competitive pricing and how you think that positions you when you think of consumers really trying to tighten their belts, preparing for a recession, perhaps not wanting to spend as much or trading down with other products, say, like a Starbucks.
Sure. We have 3 brands, Folgers, Dunkin', and Bustelo, 3 of the top 8 brands in the category. Folgers is the #1 brand. Again, here we play across the value spectrum, offering products that consumers can't afford. But even our Dunkin' brand, which is the more premium brand, has actually returned to growth this quarter. And so we would expect to see that momentum. Pricing is competitive. We're seeing the pricing in the category more normalized, and that allows us to compete effectively and continue to grow all 3 brands, which are showing solid performance.
And let's make way into that Dunkin' brand debate. You're looking to make a bid for Gen Z here. You're launching a liquid coffee concentrate in July. You're saying that is something that Gen Z really enjoys. Break down for us how exactly you plan to launch this and why exactly you think now is the right time, and what sort of response you're hoping to get from this investment.
Totally. So 71% of cups consumed of coffee are consumed at home. And as the leader in coffee, over the years, we have effectively transitioned our portfolio to where the growth is. So you think about K-Cups, premium coffee, there was a shift there. Consumer behavior is now consuming a lot of liquid coffee. They're making customized drinks at home in the morning. This is, millennials and Gen Z are doing a lot of this. And so launching the Dunkin' Concentrate is a perfect way to get into that market. And then later in the year or in the next fiscal year, we'll be launching liquid coffee for Bustelo as well. So both of those brands will be playing in that space, and just another example of us shifting to where the consumer needs is.
And we've been talking a lot over the past year about snacking, about how people just aren't willing to pull back on their snacks. It's like your one precious thing to hold on to. Talk about that consumable market there, and what have been the strongest growth drivers for you?
Well, Uncrustables, as you know, peanut butter and jelly sandwich is the #1 lunch sandwich in America, and that product is a rocket ship. We're building our 3rd manufacturing facility to make more PB&J sandwiches. It meets the consumer need of being portable, on the go, convenient, and no mess. And it actually has no prep other than allowing it to thaw. So it's something that parents love to give their kids. You can see, you were talking about golf previously. The golfers are obviously eating it, and even during the March Madness, we were fortunate enough to have many of the commentators, including Charles Barkley, profess their love for Uncrustables. So it is a universal product that is loved by all Americans.
Mark, really quickly here, we're hearing that sugar inflation has finally caught up. Ingredients cost about 70% of your total goods. What are you seeing as far as inflation impact on your ingredients so far this year?
Yeah, to be honest, it does come back to making sure, first and foremost, that our products are meeting the value needs of our consumers, which they are. We do view that we are still in an inflationary environment. It is nothing like some of the inflationary environments that we had over a decade ago, so we think that it's manageable, and we continue to work to manage our own costs. And as we've passed along some of the price increases, we've done that in a very prudent and thoughtful manner, working with our retail customers to continue to provide value to the end consumer.
That was Mark Smucker, CEO of JM Smucker Company, alongside Yahoo Finance's Rochelle Akufo and Brooke De Palma. Well, coming up, we're going to check in on a few trending tickers moving after hours. Stick with us.
Let's take a look at two names trending after hours. We've got Stitch Fix, tongue twister there, and Dave & Buster's. Kicking off with Stitch Fix. That stock up just about 5% here in extended trading. Investors satisfied with these results for now. Revenue topping expectations. The company also reporting a narrower than expected loss. Also some cost-cutting initiatives here, more cost-cutting initiatives here from the company. They're closing 2 of its 5 distribution centers. Also talking about that they're exploring some options here in order to exit their presence from the UK. We know Stitch Fix has been under a bit of pressure as of late, with shares off 22% over the last 3 months. You're looking at year-to-date gains of just about 18%, but over the last year, the stock off nearly 60%. Active clients are down on a year-over-year basis, off just about 11%. Fourth quarter sales guidance also coming in a bit light here, but the street focusing on that top and bottom beat. Shares up just around 5.5%. Flipping over to Dave & Buster's, that stock is also on the move. A mixed report here from the company. Taking a look at what we're getting here, they beat on profit, they missed on revenue, but it was up on a year-over-year basis, up just about 32%. The company also saying that they opened 4 new restaurants during the period. They also reached 2 international franchise agreements, planning to open up to 15 restaurants in India, 5 restaurants in Australia. So certainly the name has been a little bit under pressure when we take into account that consumers have been pulling back on some of their spending, not going out to eat as often. But after hours, the stock up just about 3.5%, and management very upbeat about what the future looks like here for this company. Kiko?
Well, it is closing time here at Yahoo Finance. Here's a look at some of the top stories today. Coinbase shares plunge after the company was hit with a lawsuit from the Securities and Exchange Commission. The SEC is alleging Coinbase is operating illegally because it failed to register as an exchange. Now, Coinbase says it will continue to operate as normal during the litigation process. This came just one day after the SEC targeted Binance in a separate lawsuit. And breaking news after the close, the SEC is now looking to freeze all Binance U.S. assets around the world through an emergency order.
Turning to merger news, rocking the sports world after a year of battling, the PGA Tour is merging with Saudi-backed Live Golf. And as a result of the announcement, all lawsuits will be dropped. Now, today's news paving the way for Live golfers to return back to the tour, but it's still unclear how that's going to happen.
And the Republican primary for the 2024 race just got a lot more crowded. Former New Jersey Governor Chris Christie filing paperwork for a second run for the White House. It sets himself up for another battle against former President Donald Trump.
The eventful next, 16, 17 months ahead. All right, well, that'll do it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here tomorrow afternoon. Have a good night.